welcome to the first episode of Unblockable, Human for Cryptos. I'm here with my good friend, Christian Kameir. I want to introduce him. I want to tell everyone how much I love him, how awesome he is, but I'm actually going to let him introduce himself because he knows way more about his credentials and what he's accomplished than I do, and he has a great spiel. I'd love to hear it. So, Christian, why don't you go ahead and introduce yourself to the audience?
Okay, state of the world, so to speak. So, so my partner and I have been in technology investing for some 20 years at this point in time. The funny reminiscent of my accent originated in Germany. I was a software developer for a short period of time in the 80s, discovered I wasn't all that good at it. So decided I'd go to literature school of all things, and discovered on the last day that I also wasn't good as a teacher, so I went to law school. When I came out of law school, still technologist at heart, it was the beginning of the days of the internet, and I ran into that by the virtue of me writing a doctor thesis on the topic of telecommunication and number laws. Anyway, I became general counsel for one of the very first internet service providers, and we got super lucky selling that company at the height of the .com to what's now the largest internet service provider in Europe, Tiscali.
Lucky.
And
Smart.
No, it was super lucky.
Was
no.
lucky, right?
We were doing the same thing that everybody else was doing. Like we're preparing for an IPO at $1 billion valuation. And we would have never probably made it there. I don't know. Obviously, hindsight is always 20/20.
Totally.
But actually, everybody at the time told us we were total idiots because ABN AMRO was telling us we were worth $1 billion, and we took a deal for $365 million. So that made us sound like we took 36 cents on the dollar. But anyway, it worked out fine. Let's put it this way. And so I promptly retired from the law that particular day, February 27th, 2000, and a couple of days later, literally, I flew to California to look at a team that we wanted to invest in because we literally set up a venture fund the next day. And originally, we were very interested in voice over IP solutions, multi-massive online player games. And we had already bought a voice over IP solution that we have taken out of the previous company. And so we were looking at a team in Carlsbad here in Southern California that we wanted to acquire or invest into, and I was still on I-5 looking over, passing Torrey Pines, saw the Pacific Ocean, pick up the phone and told people the headquarters going to be in San Diego and I'm not coming back. So that was 20 years ago. And so anyway, so fast forward to today. So voice of IP and multi-massive online player games share a lot in common with the topics that we're interested in today. So blockchain-based solutions, decentralized software solutions, and so forth, with MMORPGs already having in-game currencies of US dollar exchange rates in the 90s, and then voice of IP is the most used peer-to-peer solution in the world. So we were very early in the blockchain space. My partner, who you met, created the Ethereum meetups here in Orange County. That's how we found each other. And we set up our first fund, and we mostly are focused on what we call value transfer system and invest in those. And we're very thesis-driven. We're very scientific in our approach as much as we can. We use the scientific method to decision-making. So the way we go about this is we write our own thesis papers, some of which you read, some of which you can find online. And we run them essentially against the projects in the space that we engage with for peer review. So at this point in time, we have about 650 peer reviews on all of those ideas. It's super, super helpful, right? Because you have an army of people that essentially collects this data for you and is maniacal about solving one particular problem in, let's call it the finance space, or all the adjacent spaces that we look at, which is legal and regulatory solutions and so forth. Yeah. We also have a small hedge fund team, and we also have a dozen developers in India that are working on some DeFi-related things, but most of our time is really spent in early state startup investing. Given the nascency of the space, we've been focusing on seed Series A stages for the time being, and then for the first time this year, we'll allow a few partners, limited partners, into the fund to then extend this to the later rounds.
Very exciting. I mean, you guys got that lovely office down in Newport Beach, which I visited. I love it. Love visiting you there. You got a great team, and like you said, you guys are one of the more sophisticated teams I've seen. You have very deep understanding about the blockchain industry, cryptocurrency, especially around the regulatory space, which is a big thing that I come to you for because your background in regulatory understanding, with merging with your understanding of technology, I think is so rare and so valuable these days.
Yeah, I mean, blockchain exists very much at the intersection of law and technology. Yeah. And that's kind of where the biggest gap at the moment is still. I mean, it goes all the way back to the ICO days when really a lot of legal professionals kind of soured the deals for us. It was really upsetting to see the advice that these people gotten. So, and they're specific, I don't know how much detail we want to get into here, but If you develop the technology as intended, there's no reason that you should be exposed to any regulatory risk, right? If it's just a peer-to-peer solution, if you don't take custody of the asset, if you don't take custody of personal identifiable data, there should not be an exposure to it. That's why there's all these, what I would call misguided terms floating around, like a regulated token and so forth. That's an entire misnomer, right? It makes no sense whatsoever. It's just not an understanding what the technology is supposed to deliver on. If you do that, well, you just left everything that we are interested in investing in, right? Because we don't want to hand over $1 million check and you spend half of that on legal regulatory filings. So you just missed the mark entirely. Because I mean, the typical example for this is Skype, right? When they started out, how many telecommunication licenses did they try to acquire? None, right? Because it's a peer-to-peer solution. It's quote unquote voice over IP, and a lot of people have been using this term money over IP to describe what's going on in quote unquote crypto, right? I kind of stopped using that term, eventually realizing money itself is friction. That's a much longer conversation, but it's kind of a step in between understanding that this is about peer-to-peer solutions, as in if you're the one doing KYC and if you're the one then storing personal identifiable data, and obviously if you're storing the asset, that's the opposite of what this technology is supposed to deliver.
Yeah, I get this image of a horse tied to a car.
Yes.
So this defeats the purpose of the first one. And why bother? Right?
Yeah, exactly. Makes no sense whatsoever. And it's actually much worse even, because if you look at custodial exchanges as one example, they really kind of infringe on what we would call the herd immunity of the blockchain itself, right? Because that's how you enable like these analytics companies then to drill down. And even if you're not the one doing it, if you're receiving funds from there, now you got this chain where they can follow you around. And it's not about you, and it's also not obviously about doing anything nefarious, because 99.99% of all transactions are obviously not nefarious. That's kind of this legacy also of thinking within that financial space, as in we deputize those financial service provider to spy on everybody and kind of do the opposite of what the space should be about, and the space of finance, I mean, where every private transaction is basically public and a public transaction is essentially private, right? Exactly the opposite of what we need. And in my mind, not to get too philosophical about that, but that's something that the technology should solve for, right? But
please, let's get philosophical. That's the exciting stuff, right? No, I love your philosophy on this stuff. I mean, we share a lot of, that's where we overlap the most, right. I think, on our overarching philosophy about money and non-national digital money. And I'd love to expand on that more, but please continue.
Well, having been exposed to regulation, I wrote some of the number regulation for the European telecommunication markets. I eventually pretty quickly after a year came to the conclusion that technology will obviously always move much faster than regulation ever will. So it's a much better investment of my time to focus on technology, and then eventually also focusing on technology investing and support those people that have the right ideas, and or educate people that should be working together to build the right things.
Yeah, and the regulatory stuff is always a problem, isn't it? I'm the CEO of a company, right? I have regulatory expenses, and just navigating that has actually been one of the more costly things in our entire business when we go back and look at it. So right. that trying to be innovative and push the boundaries on a technology side, you start to run into regulatory barriers or just dangerous areas where it's gray, and maybe you misspoke, or maybe you structure something slightly off in a way that you shouldn't, and next thing you know, you've opened yourself up to hundreds of millions of dollars in damages, assuming you've had a successful token sale or what have you. And that's a nightmare for any project, right? To suddenly find yourself staring down this regulatory barrier of large fines, taking back all your money, losing your ability to have future projects go out there. So, I feel like we have to be very defensive on that area, but also I think what we need to do is just design things that make it unnecessary. Design things that make the regulatory structure that we currently have completely unnecessary, which I think brings us to the most important thing I want to talk to you about today. The thing I think everyone needs to hear is your position on digital personhood, which I think is a key component to the regulatory side of all of this. I think it kind of gets us past it. If, for my part, digital personhood, in that it doesn't require normal KYC AML rule sets. It doesn't need a birth certificate or a social security card necessarily. You could build one that does, but I think building systems or a type of personhood that are connected to peer-to-peer financial transaction systems that don't require KYC AML. That excites me, right? Because that allows me to help a lot of people. But I know you have a completely different sort of granular understanding of it, so I'd love to hear it.
Okay, yeah, let me unpack this. So let's start from first principles. So first of all, the innovation and the invention that was blockchain, right? So the Bitcoin white paper didn't invent blockchain technology, right? It put blockchain technology together with proof of work to then, on a technical level, solve the Byzantines' general problem, but then on a innovative level, solve things like digital bearer instruments, like the lowercase b Bitcoin being the mining reward, being probably the first digital bearer instrument, and then as a structure delivering on the first decentralized autonomous organization. So
Which is the part I like. I like the, you know that I love DAOs. So
yeah, me too. I think
and
yeah.
Let me just unpack this for those at home who don't
Sure.
understand what he means by bearer instrument. It means we've made digital things have physical properties. So if I hand him or send him this digital item, he now possesses it as if I physically handed it to him. And that's a really important distinction that I think the average person outside of our industry just doesn't really grasp. They don't understand why cryptocurrency such as Bitcoin is so valuable, because they don't understand the utility that you unpack once you could create digital physical objects.
Yeah.
So great. So digital bearer instruments. Got it.
Right. So, but really from a practical perspective, the most important innovation on top of this is what I call unstoppable code. Typically, people refer to this as smart contracts, which is a little bit funny for something that's not smart at all.
Dumb programs.
I mean, they're mostly kind of if-then rule. But the point there being is what these if-then rules allow you to do is create code that's then executed by an independent network of miners, or providers of the network that participate in the network, make it run, so to speak, that you can't necessarily easily stop. And oftentimes people refer to it as it's a mutable transaction. That's obviously not quite correct. I mean, nothing is really immutable, but it's immutable-ish, and mostly that's due to incentive systems, right? Because in order to participate in the network, you usually have to own part of the network, as in you have to either own a token and stake it, quote unquote, and actually run a node. And so, correct. So, i.e., it would for the most part be self-defeating to interfere with the system. And the funny part is, if you think about like the differentiation between decentralized and distributed, most people still conflate those two, as in essence, if you were the only one running a node, the system would be not at all distributed, right? You would be the only one running a node, and obviously when Satoshi turned on Bitcoin for the first time, he was the only one running a node, as one example. But obviously, once it becomes valuable and people start transferring these things, even if you're still the only one running a node, what is your incentive to mess with that node? You would never do so, right? And
won't hope not.
no, it would defeat the purpose, because all of a sudden your currency, your digital asset on that particular network would be worth nothing, because it relies all on trust that it's going to be worth something tomorrow. And once you erode the trust, it's very hard to go back. It's basically impossible. So funny enough, even if there was one node, in essence, that actually would be more immutable than having 10 people run it, in a way.
Potentially. It depends on the intent. It depends on the intention of the person running the node, right?
Well,
How you design the system.
Well, with 10 people, you have an inherent conflict, right? There's people who have other ideas, and you get forks and so forth. And we have seen that. But anyway, maybe we'll just stay away from
that's a black hole of a topic, right?
Exactly, the technical nerdy stuff, and also I don't think for most people that's all that interesting.
No, not at all.
Just interesting.
I think the issue of personhood is the one that we really got to tackle, because people need to understand how important this is to them. It has parts about data privacy, control of your money, all that stuff. Yes. Right? So knock it out of the park. All right?
It was actually getting towards that, because you need those smart contracts, those what I call unstoppable code, to solve human-to-human interaction. And what I mean by that is, I actually don't think they are real peer-to-peer transactions in the future. It's more like the topic of what I call digital vending machines. And apparently I stole this term from Nick Szabo, although I don't remember how he's using it.
That's what I used to call Bitcoin ATMs, though. I just called them Bitcoin vending machines.
Well, no, I called them digital vending machines, as in the way I think about this, and I just published a short article about this, but the way I think about this is, if you have a right or an asset, and typically we talk about rights transfer, even if you call things a digital asset, most of the things that people call digital assets are really rights. And so let's think about like something like the title to your car, the deed to your house, and so forth, right? So these are all documents that then transfer rights to something in the physical, in the real world, so to speak, in meat space. And so the point there being is, so yes, eventually we might actually turn these into some form of digital bearer instrument. But the way these are being transferred is a complex legal process right now, and still will be a complex legal process in the future where multiple entities are involved. So let me kind of collapse that for a second to make this kind of more visible. So in the future, in my mind, how this will work with almost everything is you will have a digital vending machine in the sky, so to speak. You will authenticate yourself with whatever asset or right you want to sell, and you prove to that digital vending machine, I'm the owner, I have possession, I'm a real person, whatever the requirements are for this particular thing you're trying to transfer, and you leave it there. Just like you would kind of leave it on, let's call it eBay or Amazon for that matter. You deposit it in Amazon's warehouse and they take care of the rest. But this is all about just digital things, right? The digital equivalent. So, and there's a whole stack involved for that and for different assets that you need to check off, right? And a lot of times this is all about asynchronous value transfer. And so the next person can come by and kind of do the same on his end, right? And he has never met you. He has no idea who you are, and maybe it's relevant for the transfer of the item. Maybe it's not. Oftentimes, it won't be won't be interesting or valuable. If you're buying a house that Elvis lived at some point in time, might be interesting, but if it's just John Doe, then you probably don't care that was John Doe that lived at that address in the house that you bought. Same with a car, and same with almost anything that's part of daily transfer. So as such, all you're doing is the same thing. You authenticate, verify, certify, and it's about 9 layers that you on average, not on average, but that are possible that you might need for legal relevant transactions. And at that point in time, you take that right and take it to wherever it needs to be executed, i.e. I need to still go to a land registry. I still need to probably go to the DMV for some time. And then you take possession of that item, right? And at some point in time, the digital vending machine will then release escrow if you check off all the boxes. And there's obviously a lot of, let's call it oracles and so forth involved that need to certify for that. But the larger point here being is, that's why I said a lot of these interactions won't necessarily be peer-to-peer. It's like peer to machine to someone else. So it's just like there's no custodian.
That machine is like a service or something. Like if I'm transferring the bearer instrument representing the ownership of my car to you, there needs to be a lot of stuff that happens behind me, but I don't want to know about it. I just want to transfer ownership to you.
Yeah, that's why the vending machine makes such a good example. If you had like a universal physical vending machine where you could put in stuff, put a price on there, right? You just go there, deposit stuff, close the door, say I want $5 for that when someone takes it out, and someone just comes, put in $5, and the $5 go to your digital account, and everybody's happy, everybody's done. No one needs to have KYC done on them and so forth. No one needs to have their privacy violated and copies of their identification floating around. So, and so unfortunately, we did probably 200 some analysis of all these companies that pretend they provide identity solutions. So, and oftentimes the most abused terms in that space is digital identity. It's usually used as a metaphor for a profile, as in a collection of data that carries personal identifiable data that's specifically used to profile you, as in to target you, right? They present you with an offer or ads or whatever the case might be. So that is about as far removed as identity as you can imagine. Like so, the profile and so equaling digital identity. There's just a misnomer.
Could you see a profile having integration with a digital identity, like it being a component of it, or is it just unnecessary?
Well, I take those words very serious and very literal. So if you talk about identity, I think you need to actually include human consciousness. So what I mean by that, there is people working on actual
proof of consciousness, right?
They're working on actual digital identity, as in preserving who you are in digital form. In essence, there's people working on this right now. So once that happens, that's digital identity, right? If your body should be damaged and you can't transfer everything that makes up you, all your memories, all your attention and so forth. That would be digital identity. But obviously that has nothing to do with a profile because, I mean, your body doesn't even exist anymore. Right? So,
I'm thinking from a legal standpoint, though, like personhood, like being an entity, being like a legal entity, the ability to own things and transfer assets. That's the one I'm after. Right?
That's a totally different word.
Yeah,
and that's my point. So, unfortunately, I was a lawyer at one point in time. So I'm
very specific, which I appreciate about you.
Well, I taught privacy law at one point in time, but I'm really a technologist at heart. So a lot of these things are obviously about legal technologies. And so in a court of law, what you essentially at the end of the day need to prove is human agency, as in it's observable human-directed behavior that culminates in some form of legally relevant action. As in right now, and I'm skipping a lot, we can go backwards, but right now, the only real identity management systems that are out there are those social engineering as a service companies. So the Facebooks and Googles of the world that trick you into clicking on an ad, doing something, they actually are the closest what you could call identity management that you could imagine, because those transactions I can actually see. I can observe human-directed activity leading to a purchase, leading to a click, leading to something that I can record.
But we as end users have no agency in that realm, right? We don't have any say other than our own actions and what we're doing in the space.
No, from a legal perspective, that's considered agency. Otherwise, that purchase would not be relevant. It would be voidable.
I guess I should say we don't see our own digital person, that thing that Facebook sees, that version of us that they see. We don't see that, right? That's invisible to us.
Correct, yeah. And that has, again, it has little to do with identity. Obviously, it's a profile, and they have like 4,000 or 5,000 data points on you, and they know more about you
than you know about
yourself. Exactly that. But yeah, at the end of the day, what we need to build is kind of the opposite. And that's why we were in the pre-roll kind of talking about my second book that, well, you get 10 years to write your first book. I'm 12 years into my 10 years on my first book. And so the second book is going to be about the topic of reversing the attention economy.
Which I'm going to read immediately, the first day. Like, in fact, I insist that you give it to me before you release it.
We'll do that.
I definitely want to read it because I love this topic.
But so, yeah, the way I look at this, so right now we all got our attention stolen all the time. And so really when people say selling data, I mean, people don't really buy and sell data. I mean, that's a means to an end. You buy a hammer to build a house, right? So you buy this data to then profile and get you to do something, because data by itself obviously doesn't have any value, right? So you're using this data to create a profile and then either predict what you would like, what you should be presented with, and that's kind of where we kind of jump the shark in a way, social engineer you into doing something. I mean, we've seen lots of statistics now, and there's more and more evidence that we went from like social media as a service to social engineering as a service.
Absolutely.
And we've seen that with like the most outcry obviously was the whole Cambridge Analytica hack, but I think that's just the tip of the iceberg.
That's the one that we could see.
Right.
That's the one that we could see.
Exactly. So, but the larger point is the obvious one if you peel this back for a second. So the World Wide Web, or the internet in general, with the World Wide Web being the most visible implementation of the internet, is a commons, as in it belongs to all of us and it shouldn't be monopolized by particular entities for their own gains and polluted. But we achieve the opposite. We have a digital landfill that we call the World Wide Web, and there's very specific organizations to blame for that kind of facilitated that, right? Because my typical pet peeve, as you know, is like if you do a Google search, you're not searching anything, right? You're running a query against Google's index. And as a result, you don't actually see the World Wide Web ever. You're never on the World Wide Web. If you do a Google search, you're just in Google's environment, whatever they like to index. And unfortunately, the way the business model works as a subset of them being a for-profit corporation, also publicly traded, you're the product that they're selling to the advertiser.
Absolutely.
So they have no incentive to actually provide service to you because you're not their client, right? They're the product. So why would they care about you?
This is an issue that's so dear to my heart. I mean, we literally have a line in our company that said people are partners, not products.
Right.
You're contributing the value, so you're a partner.
Right. And so that's like a very typical misalignment of interest. But the overarching point here is more that if the World Wide Web is a commons, if the internet is a commons, then it shouldn't be able to be not monopolized in the particular way in this particular filter. But then more importantly, obviously, we kind of stopped developing on it. And in my mind, we actually never developed the World Wide Web. We developed the commercial web, and now we finally have the tools to fix that. And that's why I mean by reversing the attention economy.
What's the most exciting thing in decentralized web, though, right now? What's the one that you think is going to get us to where we need to go? Because I've seen so many, and I'm not technical enough to analyze them in any meaningful way. So,
I mean, there's teams working on all different aspects: decentralized DNS, decentralized storage, decentralized bandwidth, everything you can think of, decentralized domains. Right?
So a web of all of these working together gets you this kind of
correct.
What the internet was supposed to be.
So that you don't have to rely on AWS, you don't have to rely on your internet service provider, and you move anonymity and privacy to layer 0. And at that point in time, all these other services won't actually be able to access anything, right?
Do you think that's important for personhood, to that level of privacy of just like you can't see it unless I want you to, right? Absolutely. My information is
needs to be
sacrosanct.
default because Roger Dinkelstein, who developed Tor, the onion router, right? He has a really good way of explaining that. But essentially, in short, you never know what you want to be private when you do something, right? You just find out later, oh, that should have been private, right? So there's nothing for you to opt in that sense, right? You can't even consent to something because you have no concept of how this information is going to be used. And we see this on a daily basis now, right? There's people that surfacing some form of malicious thing that someone did 10 years ago, and that he gets penalized today. She did this particular thing that people don't like today, but she did this 10 years back when there were whatever, a minor or something else. And the point is never that malicious people should be protected. It's kind of the opposite in a way, to where in order for us to live in a democratic free society, privacy is a necessity, right? Because otherwise, if that's not the case, if you're living in total surveillance state, what will happen is we're all going to start self-censoring, right? It's not even about not saying something. It's already like thinking about, oh, can I say that? And you won't. And that holds true with the things you say, and that holds true probably even more so with the things that you spend money on. Because what is more an expression of self than how you use your funds at your disposal? To me, that's actually more an indication, because people say things all day long and the next day they change their mind on that. But if people actually commit funds to a particular transaction or to a particular cause, they literally staked their money on it.
See, I come from the perspective that your information, and I think over time we're going to move in this way as a culture and as a civilization, but that the information and the data that you put out into the world is a part of you.
Yes.
It's like an extension of your soul. It's your idea. It's your mind. Like if someone breaks into your computer, breaks into your phone, it's like they're breaking into your mind.
Right.
And I think we need to build laws and sort of develop a metaphysical perspective around that.
Right.
Like that is part of you. Right?
Yeah. So your identity is made up 100% of your attention.
Yeah.
Right. You could be sitting here thinking about something entirely different, doing something entirely different. It's 100% your attention. So
you are what you focus on.
Yes. And so the point here being is it should be penalized if people steal your attention. And I keep insisting on that. People steal my attention for something, they direct it towards something, because time might be something I can't get back. I still have this theory.
I think I have the solution. The thing for me is to tokenize the attention economy in such a way where everything you look at, you're being paid to look at it. You wouldn't bother looking at something unless you're being compensated.
So
right?
I've seen such models. They will always fail.
You think so?
Yes, I know.
Why?
So we have seen lots of those models being proposed.
Okay, get this on record. So if I get it right, guys, and I proved Christian Kameir wrong, if in 3 years I have an attention economy system that is pegged to a token and is powering it, it's working, and like I said, I got you once. No, but I assume you're right though. So let's. Why don't you think it will work though? What are the problems you've seen with it? Maybe I'll learn something here that'll be useful for me.
Where do I start? So you would still have to get people to opt into that, right?
Sure.
That's the problem.
For anything,
by default.
right?
So
you got to get them in.
I mean, you've seen kind of the approaches that Brave takes, for example, and so forth. And if you do the analysis, people aren't interested in doing that. Right? They're simply not interested.
Okay, but let's say if I figured out how to do that part. Okay, let's assume we onboarded people. Let's assume
if there's the slightest friction, they won't do it.
Yeah, absolutely.
You need to tie it to, let's call it human flourishing more than anything else. It needs to be outcome oriented, right? That's the only way to make that do. But simply paying for attention is sort of vacuous. It works in the sense of, if I directionally provide you a service that can be metered in time and attention, then you want to stream money to that particular action, i.e. I do a consulting job for you, and every second is metered at a certain, let's call it token. I don't necessarily agree with the whole token thing, but we can talk about that. But the larger point there is, for the most part, what I'm hoping to see is that we use technology in the way it was intended. So, and I mean this like very, very high level, as in all technology had at its core the purpose is that you can be relieved of some form of, let's call it busy work, and you can direct your time and attention, or your attention as measured in time, towards higher order activities. I mean, that's why this morning I just wanted to look this up again to see like how much time is like I like to take very high level views. So how much time during human history we spent just like running around in small herds, if you will, which was the most time, like 98% of the time that Homo sapiens has spent on the planet. We were just hunter-gatherers running around in groups of 30 to 55 people or something like that. And so it's only been like 10,000 years that we settled down. So my point here is within that short period of time, though, we only developed this whole concept of money and so forth to make up for the activities that I didn't want to do. Before that, all these activities were simply social contracts. And that's why it's always false to say things like gold was the first technology for money. That's not debt was always the social contract was always
you do something for me, I do something for you.
Was actually for 98%, actually for much more, because you really have only these financial instruments since the Industrial Revolution. Because before that, and that's the other point, before that, people spent like most of their time still toiling in the fields, right?
It's about delegation of labor. It's about splitting up and making a more complex civilization, right?
Right. So I was trying to make a bow back to technology. So we develop better technology, right? So people don't have to toil in the fields. And so now, ideally, they should direct those freed up time and attention towards higher order activities. So what is higher order activities? I make a particular example that I care about, and in my mind everybody should care about, is we all, as humans, suffer from mostly the same problems. We all might die, and that's a really bad outcome.
We all get hungry, we all get lonely, we all get cold.
I find dying very boring. I don't want to do that. So let's not do that. And
I hope it's not boring, though. I hope it's exciting. That's my.
I wouldn't want to bet on that. It's like, and we proved in theory that this is possible. We proved this in the 1940s, but we haven't directed enough resources on that. And instead, a lot of people spend their days watching cat videos, right? So the point there being is human-directed activity could actually be channeled to something that serves us overall, and then being selfish just serves me as an individual. If I get to live longer, if I get to breathe
ideally it's
clean
both,
air,
right? Ideally it's a win-win, right? You win as an individual, the society wins, you're more productive, you're more well-educated, you live longer, you just contribute more.
Right. And so that's why like this intermittent thing of money, or let's call it tokens today, is just a blip. It will always be just a blip. Right? It will go away, because money itself is really fraction. So what do I mean by that? So the best technology we ever invented was language. And unfortunately, a lot of people don't spend enough time on that. And so they say a lot of things, or they talk a lot without saying a lot of things. And so you need to become really, really conscious about the language that you're using, to direct your own mind, right? Because you program yourself all day long. But then also, if you want to have valuable communication with other people, that actually changes people's minds, because otherwise you talk about toasters and I talk about cats and we never know that we did. And that's 99% of the conversations that I see on TV, I see on the World Wide Web. But then also as a technology investor, Your language is the ultimate tool you need to build anything, right? And in the particular fields that we're interested in, which is cutting edge technology, you got to develop new language, right? Because there's new inventions in that space that we hadn't seen before, and there's innovations on top of those inventions that are now possible, but if people don't develop the language to build this, you can't build it. Right?
Essence precedes existence. We have to get the idea of the thing to exist first before we can birth it.
If you don't understand the nuances of identity and you make up terms like digital identity, not realizing that you're using something that's not within the technology realm, it belongs in transhumanism. You cannot use that term and then start coding in software, which is also a language, something that will work. It doesn't, right? It simply can't. And that's very disheartening to see, because I see this on a daily basis. I've seen hundreds of projects where I look at the glossary and either, oftentimes, it doesn't exist. That's the worst part. It's like you didn't define the terms that you're using, and this is this new context that you're using the term, and you want to be very, very, very precise in how you're using that term if you want to implement this in code. Remember, we were talking about smart contracts earlier. At some point in time, it will probably find its way into a smart contract. It finds its way into a digital vending machine.
And hopefully you got the language right?
Yeah,
hopefully,
well, if it doesn't, it won't work.
Yeah.
Period, right? I'm simplifying it because it's way more nuanced than how I'm describing it here. It's much more nuanced than that. But the larger point is always the same. You want to refine the words that you're using before you're using them, which is really upsetting to my editors at all times, because I already take a paragraph to define the word that I'm using, and then editors like Forbes limit.
You lost them already. That
No.
attention span's too heavy. It's
that
too heavy.
too,
It's
but then
taxing
also
your reader,
they limit me to 1,000 words. It's like I have that takes the longest times, because my short form articles are 6,000 words, right? So to get this into like I write my 6,000 words, and it will take me a couple of weeks, and then it will take me a couple of months to make 1,000 words.
So the digital identity thing of like transferring human conscience, that's not what we're talking about today. We're talking about like, how do I give someone who doesn't have access to financial tools, like universal basic access to finance? Like that's the goal, right? That was like the original goal of crypto, was to get everyone access, make a system that's permissionless. You could all now have access to a bank account or money or something similar to it, that get that function, that ability to transfer, right? I'm suggesting that identity, or not, we'll talk about personhood, right? Because you don't like that word identity. I don't think I like it anymore either. But the ability to just own stuff, to transact with other people that own stuff, to have the rights that we as first world nation members just take for granted all the time. The ability to just, I actually own something and you can't take it away from me. That's a big deal for most of the world. And I think that's when we talk about, we still haven't solved the problem of peer-to-peer digital cash. I think part and parcel for that is that because we haven't also created the systems which give people the functionality that we've come to know that we used to use money, right? Like banking, checking, all that stuff. Those are things that we normally use. I want people who don't have access to a bank account to get those functions too.
Right.
All right, so I'm not going to be happy until we get to that stage of the industry.
Yeah, and that definition is just my biggest pet peeve outside of identity, as you probably already know. So the point here being is, and I'm trying to make up these stories for the time being, so people can actually like embrace these concepts. Because if I just use language without a story around it doesn't stay.
No. So like, show me the workflow, right?
No. Yeah, exactly. Think about this very simple example. So let's say you're standing in front of a house and you're interested in buying this house, and you're thinking, it might be worth $1 million. Yeah, it might be worth $1 million. And so there's another person standing next to you, and he's looking at the same house, and he's thinking to himself, I think it's probably 890,000 euros. And there's another person standing next to that person, and he's thinking to himself, I wonder if the buyer will accept 20 million pesos. So what does that tell you? Money, if it's just one person, is just language. So, and it's typically the language you have been indoctrinated in, right? So if you grew up in the United States, your language of value is probably the US dollar. If you grew up in Europe, your language of value is probably the euro. If you grew up in Japan, your language of value is probably the yen. So now let's move forward, and we introduce the owner of the house. So the owner of the house, which is in Kyrgyzstan, and I probably mispronounce it, but it's a real country, and it's at Dujambi Park, close to Dujambi Park in Kyrgyzstan. And so the owner will accept a certain number of somonis, which is the local currency there. So now what do you have to do? The first thing you have to do,
Translate it.
correct, you have to translate the owner's language of value into your language of value. Right?
Or yours into theirs. Assuming
Or you pick one that you both learn, right? So that just actually it reinforces the point that money is language. But then the next thing is you need to agree what language you want to use.
So I think we could get past that part, though. I think we don't need the agreement because the system could do the translation for us in transit. I could send you the U.S. dollars and you could receive your simonis. That
is exactly correct, and that's what we need to build. But maybe we'll just walk through the entire example, and then people might have a useful way of thinking about it, and hopefully finally build the right solution. Because you're right, we still don't have peer-to-peer cash, right? We still don't have peer-to-peer digital cash. So coming back to that example, so now they agree on something, right? So that tells you money, if there's more than one person involved, is an agreement. And you might default, and most of the time unconsciously, you might default to your local currency, quote unquote, your local language of value. And you just hand over a dollar, you don't think about it, that you could have done this with something else because it's simply the practical thing to do. So those are the primary functions of money. So going back all the way to 1875, and that's the definition that everybody keeps citing from the Jevons, being money, a store of value, unit of account, a medium of exchange. That was already kind of wrong when he wrote it down in his book. And everybody keeps reciting that. The reason why it's wrong, it's referring not to money, it's referring to money as a technology. It's very different, and we get to the money technology part, right? Because money hasn't been a store of value for most people for a long time, obviously, right? And
it's deflating.
And so I'll move fast forward, and then I'll move back. So the default medium of exchange for most people has been bytes for decades. Most people don't use money, at least not in large quantities, to store value, because specifically fiat, government-issued currency, is inflationary, right? And the typical example I make for that, you usually don't leave $1 million in your checking account.
Nope.
Right? Although
wouldn't be insured for that much, and also you'll be losing money on it. Just sitting there.
And unfortunately, right now there's like $12 trillion still sitting in CDs that lose money. But we'll get to that too. Anyway, so this definition has only always referred to particular money technology, and they are only specifically to commodity money. Commodity money was used for a blip, for a very, very short period of time. It was just not very practical to have gold coins, and it wasn't even obtainable for subsistent farming, right? And as I mentioned earlier, we only have been settling down for the past 10,000 years, and the Industrial Revolution was only in like 1706 or in the 1800s. And even something like commodity, quote-unquote, backed money, which the term is by itself already contradictory, but I can explain why, only were true for a very short period of time after World War for the United States. We use this, for the time being, when we talk about money, let's kind of confine ourselves to the United States and not touch all the other problems.
It's a lot simpler.
Because then we're here all night. But so even this commodity-backed money obviously was only around from like 1946.
And in that case, the money
1971.
represents whatever commodity you're backing it by, right? Like it's redeemable for that thing in most cases.
Which is also what? It's also a contract.
Yeah.
It's just another contract, right?
It's a debt for the thing that you owe me, right?
Yeah.
For whatever it's redeemable for.
Right. And
Commodities.
that's why these things are called notes. The debt instruments, right? And that was always the way we did do business, right?
Which, thank you for suggesting I read the book, The First 5,000 Years of Debt. A little dry, but I learned a lot.
You did read this.
I read like the first third of it, and I was like, okay, I got it.
I can actually, I am about to condense this entire book in about.
Please do. I made Steve read it, and he was complaining.
You did?
Yeah, Steve got through it, but he hated it.
So what helps me, and maybe it will help you and others. So I do these exercises where I zoom out, right? And I zoom out, and in my office, you have seen it, I have this big whiteboard, and I have kind of the condensed whiteboard version on this. So I look at, let's call it all the money in existence, and for our exercise, we just limit ourselves to the United States right now. So there's a certain pool of quote-unquote money out there, right? So the largest pool of that money we call mortgages. So there's about $15-16 trillion in mortgages out there. So that right now represents about 36% of our money. Then the second largest pool is certificate of deposits, and the last number I checked had about 12.4 trillion in it. And then you got other classes like corporate debt, and then you got cash, and then you got cash is like 2 trillion, and then you got student loans, you got auto loans. I have a class here that's credit cards. Credit cards don't belong in that class. I explain why. And then you got things like checking accounts, right? So they all refer to the two main technical utilities of money, which is money is just lending or spending. And so mortgages are lending from banks to consumers. Certificates of deposits are lending of consumers to business, to banks specifically. Then corporate debt is lending. So if you look at this from first principles, you want to do a few things, right? So you want to look at how is money created, how is it being stored, how is it being moved, and how and if can it be destroyed or is being destroyed. And you want to answer that question for all of these different categories to get to actual relevant numbers that refer to things such as inflation, which is a big pet peeve of mine, because there's all these utterly vacuous discussion around what inflation is. I mean, they're all pointing to the Fed and money printing. Money printing by itself is neutral. What I mean by that is it's important what you're creating money for. It seems self-explaining. I don't know why I have to explain it, but it seems to be self-explaining. And there, to simplify it, is important that you create money for something that's valuable, right, or productive. Use those terms for the time being.
What do you like for cryptocurrencies for their emission rate? What do you like? What's your favorite term for? Because I heard like 3 or 5 of them now: inflation, emission rate, supply creation. What's your favorite term to describe when a cryptocurrency or a digital token, whatever, creates new units? Right, because we sometimes call that inflation in the industry, but that's not accurate, right? At least that's the way the general public uses the term inflation. Inflation is like price variance against a basket of goods, right? Which is very weird to me because what happens is as long as I could keep prices stable, I could do whatever I want with the economy, and you won't notice.
Well, you also know that, like in our current definition here, housing is not included. Which is that bizarre or what? It's now more than half of a person's income, but it's not included. Oftentimes, right? And that's not included in inflation. That seems utterly bizarre. But aside from that, now the principle is really simple. You just want to put value on something, right? So you're expressing a value. That's what you're really doing. You shouldn't inflate anything for.
Which I'd like to come back to that, because I think that's a really important issue that people need to hear about, is about what happens when you inflate or distribute a currency, like how much power that gives you.
Right. And so maybe just to put a button into the whole inflation thing. So the way for now, and again, whatever I say, it's not because I feel particularly smart about things. It's always put out in the interest of peer reviews, because if I'm wrong about this, I usually like to know earlier than later. So the point there being, though, is for the time being, my theory is that creating new money causes inflation if and when it's being attributed to non-productive activities. And there's some great body of work out there, albeit by a small subset of academics, funny enough. There's the same couple of people that I always come back to when I read about these topics. But if you think about it in simple terms, if I create another $500,000 for the same house that already was around, and I sold this house last year for half that, or whatever the right number is, doesn't really matter. The point there being is the commercial banks get to create this money right now. It's money from nothing, right?
Money from nothing, and they get to decide what to do with it, where it goes. That's my gripe.
It's a non-event as far as the balance sheet is concerned, because they got the equal amount on the other side of the balance sheet, and typically it's over-collateralized with that value. And so, for the most part, these are unproductive activities. And also skews the incentive system, also skews the market, right? Because they didn't have to have that money. It puts you at a disadvantage if you want to lend money out to people and make interest that want to buy houses, because, well, you don't get to create the money yourself as an individual or even as a private corporation unless you're a bank and chartered in a particular way, and you went through all this regulatory overhead. So, and what's really odd about this is, if you think about it, of money as a common good, which is, by the way, a theme across all the central bank digital currency papers that I read, is everybody agrees on the fact that money is a common good. Right? So, yeah, I mean, we all kind of have to use it, even though there's caveats to that. But the point there being is, if it's a common good, why did we then authorize this small subset of private companies to create new money for the most part? Because it's it's probably around 83% of all money.
Kind of the equivalent of allowing someone to charge you for air.
Yeah. Streets is actually not a good example, but
just like something that we all share. Like, suddenly I get to charge you a tax, right? I get to charge you before you can get close to it.
Maybe we'll expand on the inflation theme for everybody to understand this correctly, because the primary inflation actually happens to the asset, right? Because there's mainly the inflation happens to the houses, so to speak, in simple terms. So less and less people can afford houses because they're essentially overpriced. So there has been going down year over year, like 1.5% for I want to say the last 20 years. Don't hold me accountable, but you can find this fairly easily. And then, so that's the primary inflation. The assets are being overpriced, and
in part due to speculation.
Well, no, the incentive system is just wrong. So if I can make new money, and give it to you at even low interest rate, I don't care. It's new money. I get the principal back too, and get to keep it too. But the point there being is, it obviously trickles down. So it trickles down as rent, right, and higher rents for people who have houses with higher mortgages and then rent this out. And then also it increases the overall base of money supply, obviously. So right now, as I mentioned initially, right now it's about 36% of all money, of the entire money supply, right? And it's simply inflating the base. And the point is, with inflation, there's no point in just generalizing it and just say inflation, because it's usually inflation in asset class plus. Sometimes you don't care. No, it depends on where the entry is for your money. Sometimes, I like that. This inflation.
Or if you have lots of debt, inflation's pretty good too, right?
Yeah, I mean, it really depends on how you make your money and what your debt is in, right? Whether or not this is good for you or bad for you. So to speak about this in general terms, just like you don't want to speak about money in general terms ever, is entirely vacuous. You might as well stop talking, because you can't really have a useful conversation there. So just to complete the picture on inflation, so we inflated the housing market, then you inflated education, and the inflation of education came about because the government guaranteed those loans. And so now there is no default risk. So if you have no default risk as a bank, you make these loans all day long until the cows come home.
And then if something goes wrong, you pass your losses on to the public, you get a bailout.
Absolutely. And then
Bob's your uncle.
And then over the past 10, 20 years or so, more like 10, I think, a lot of this money was lent out cheaply to corporate, to large enterprise for stock buybacks.
Yep,
and
of course.
there I don't have a ton of detail, and I'm honestly not all that interested, but it sounds reasonable that this happened, and it happened at scale, and so it inflated to a good degree the stock market and created what we're looking now. So we got primary inflation in these three groups, in these three classes, and then secondary inflation because you inflated the base.
I mean, mostly I just hear all these what we're describing are just inefficiencies caused by centralization, and inefficiencies caused by having someone control or some entity control the money supply and have the ability to just.
It's messing with the free market.
Yeah, precisely.
Right? It's like you're interfering, creating this, introducing this quote unquote regulation, but. Let the market do its thing.
The thing about, I like what Peter Joseph said about the free market. Said the problem with the free market is that invariably, one of the things that is for sale in a free market are the system or apparatus that is governing that market. So eventually someone gets big enough or powerful enough to buy that.
Right.
And once that happens, you have regulatory capture, and then the jig is up. You get crazy market inefficiencies, things stop making sense. And I think that's kind of what we've arrived at.
Right. So you want to go back to money and technology?
Yeah. Let's do the money. The money thing. I think we have 10 minutes left. Let's talk about what is perfect money. If money is not a store of value and what have you, what is the thing? What do you think money is in the future? I know you said in the future you don't think we'll even have numbers attached to money.
Correct.
You just think it'll just be happening, which I think is a tremendous evolution.
Sure. Comes back to money. So without any other party, money is just language, right? And so if you would walk out right now and you saw a number on a banana and it didn't have a dollar sign attached to it, you would assume it's dollar, right? And so, in my mind, what's going to happen once we have peer-to-peer cash, whoever is actually creating peer-to-peer cash, and there's a long list of facilities to peer-to-peer cash. I actually started creating this big Excel sheet yesterday that has
But
all
we'll share it if you want.
Well,
We'll put it
I
up
will.
on
I
the
will.
podcast.
I want to share this with all the different groups that are working on CBDCs, because that's the one thing they need to understand. In essence, what you want to combine the best of all worlds, because account-based systems make sense and they're working fine right now, but they also have drawbacks. The main drawback being that they're all, as far as I know, all database driven. And databases, they can't be protected, they can't be secured. Databases have usually a single operator. Databases can be hacked. Databases have access issues.
They're honeypots. They're honeypots.
That's definitely a
targets.
good way to put it. But then also, you're introducing all these other secondary exposure, like, because this particular company also then has their own obligations. They also have their own contracts, and so you're piling inefficiencies on inefficiencies, right? And so. Let's look at the physical cash that we have right now, right? So physical cash is really good in terms of what it does. And I mean, surprisingly, and that's another number that I like big numbers, right? So that's another number I still look up. Surprisingly, there's still a lot of cash floating around, and people use cash quite a bit still in daily use, such as like more than 20% on a daily basis. So
it's not a green technology, though, as I understand it. Paper money is really toxic and bad. But putting that aside, it's old technology. It's analog, right? We have to move into the information age.
Right, but it has a lot of the facilities that we like, right? It's a bearer instrument. I hand it over and it settles the transaction. Although it's not quite correct if you think about it, that it settles the transaction because I gave you a note.
You still have to get to the bank or something.
Well, no. I mean, it's a note. It's a dead instrument. You have a claim against the Federal Reserve. So if the Federal Reserve do not honor the claim, then...
Or hyperinflates the currency so that it's easy to honor the claim.
So for us in the United States, it doesn't seem to be a problem. But if you were in India a couple of years ago and you watched the news, you just learned that the 50 and what was it, $500 and $1,000 rupee notes, they're no longer legal tender all of a sudden, right?
So suddenly that's no longer money.
So in that particular case, and maybe too anecdotal to hold any water, but I think that
it doesn't hold the reliability factor, right? It needs to be reliable.
The point is simply so the physical cash still has also some drawbacks, and we call it typically it's settlement. But if you think about it, there's nuances to that, as in, and that would be the other example. If I buy something, right, and so let's say you buy a coconut and I give you $5 for it, I can eat the coconut, I can smash the coconut. You can set that money on fire. That's actually illegal.
Yep.
You can't do anything that will make it not fit for use, because you actually have only possession but not ownership. So, but you gave me ownership, and there's different.
I think that's a key connotation, because I think we need money that we do own.
That is correct.
Right? We need money not from a private institution that is providing this function or service for us, but we need our own.
Yeah. So right now you don't get ownership. It doesn't matter.
But with a DAO, you
could,
right? If a DAO was giving all the same functions of the Federal Reserve, suddenly.
Right. So what we want to do is we want to look for all these facilities of cash, right, and then combine them with all the facilities of accounts, and then again, it's like how you create this stuff, how you move it, how you store it, who gets to store it, and who may or may not get to store it. And then you pick all the best facilities that you want, and you implement this into your peer-to-peer instrument. My prediction is that one government will do this by accident.
Okay, taking bets. Who thinks? Which government do you think is going to get it? I'm gonna go with something like Croatia or Moldova.
My current thesis is that some small government will peg their own currency to the US dollar, like we've seen a dozen times across history. When their own currency failed too many times, eventually they just waved the white flag and said, "Okay, we'll just peg our currency to the US dollar." And those countries still work with a peg to the US dollar and works fine for them. So think about it this way. Yeah, if that was to happen with a true peer-to-peer digital bearer instrument, and that's anonymous, that can be held by 100 different wallets on different devices and on your Android phone and on your Linux computer.
Would Bitcoin meet the requirements for this?
Well, no.
No. Okay.
Again, it's not language. That's the point. It's missing the language part. The universal value language in the United States and outside of the United States for a lot of other people is the US dollar. So most people will fall to their secondary language of value if their own currency fails, which has been traditionally throughout history the US dollar.
And do you think that's going to maintain? Do you think that's going to be consistent, at least for the foreseeable future?
Well, again, it actually kind of doesn't matter. What I mean by that is, from a technology perspective, so that's why I have those big classes of different money. So right now there's about, what was it here, like $600 billion sitting in checking accounts, right? So this is like the nearest thing to cash, right? I can move it around, and there's all these different ways I can move it around. So I can use my debit card. I was going to say credit cards, but credit is actually a topic.
Whole other issue, right?
Well, credit is something that belongs into the identity part, which is, again, a super important thing to understand if you're building technology, because you have to build that slot, I called, on the identity side, not on the money side.
Got it.
It's simply wrong to put it into the money stack. It's a key lock system. But the point there being is, already what we do on a manual basis, that was what I was alluding to earlier, you avoid things that are inflationary. Naturally, right? And the way you avoid it right now, you create your basket of what you think is a store of value. So you buy a house and maybe you hold some stocks or hold some bonds, whatever you think. That's why store of value is very, very personal. Right?
Subjective.
And
Subjective.
Typically people don't just hold on to one thing and that's their store of value. That's why I like talking about gold and stuff as a store of value. No, store of value is just usually a basket of things. I would not recommend to anybody just store all your value in one thing, right? That makes no sense. And people ask me in terms of cryptos, like, well,
what's your favorite is what everyone always asks.
And I always say, well, I wouldn't put 100% of my money into Bitcoin. I also wouldn't put 0% in it. It's probably the right number, depending on how old you are and when you need it back. It's kind of anywhere between 1% and 10%. It's definitely not zero.
Yeah,
that's gross negligent because it's such a great lottery ticket. But the larger point here being, though, so once you develop the technology in the right way, let's say you have a smart wallet, and we see hundreds in development right now, right? So then your wallet just would make it so that you don't have to hold on to an inflationary asset. You would never know, it just does it.
It would just manage it for you.
It just and we're already seeing that right now. DeFi is just going through
we're
the
see
roof.
Like AI managed assets, AI managed personal life, right?
Right, and it's just not correlated right now. That's why I was saying, once you have a central bank digital currency, and it will likely be one that's US dollar pegged, and it's too be bearer instrument, you just remove that friction. So right now, there's always friction in the on and off ramps. Usually it's like 1% or more, right? But if you can seamlessly, let's call it via atomic swap, move into a fiat money, right? Because someone wants it for payment. That's the only reason why you would use it. And eventually those people also will be encouraged not to use that for payment, because it's another point of friction, because she has to still transfer back to something that's not inflationary. That's why I said money is the ultimate network technology.
You only use that when you're actually going to buy something.
Yeah, exactly. So
which is kind of how I've been living my life for the past couple of years, by the way.
Everybody has, right? Everybody has. I mean, very few people live in a cash-only kind of thing where they put cash under the mattress and that's how they move their life. Unfortunately, there's still more than you would think, but that's not a great way to live. But the larger point here being is, so you always want to reduce kind of this exposure to this inflationary asset. Once you can automate this, the exposure eventually will go to zero. So the classes that we call, that the Fed calls M0, which is the physical cash, the classes that the Fed calls M1, which includes physical cash and things like a checking account, should like go next to nothing. So at that point in time, think about it. All the other things are lending. Right? They all fall into the lending category. So only when you spend something, and then also only if someone wants some legacy fiat, you would, for that split second, move into that inflationary asset. So at that point in time,
at the time of transaction,
that's it, right? For a nanosecond. So think about it. Once you have that in circulation,
So we need atomic swaps, which we're working on, right?
We already have those, yeah.
Right.
Again, it's all the value, all the work, and all the attention needs to be given to the on and off ramps and make those frictions remove. And we have little tidbits here and there, little highlights here and there that make this possible. It's just not very easy right now. It's really hard work, and then there's the legal regulatory part.
And you can manually do it yourself, but it's slow and sometimes may take days to move out of the safe ass into the dangerous one, right?
Yeah, I mean this is being sped up.
Yeah.
I mean if it's already digital, right? Then
it should just be.
And if it's already bearer instrument, then there's this whole DeFi ecosystem that's doubling right now every couple of weeks.
And that's going to continue, right?
That's going to continue. But right now, it's very much insulated from the real world, right? So right now, those on and off ramps, because of their frictions, don't play a role. If you remove that friction, if you remove that, call it simply remove the 1% fee, and you find out a different business model, and that's the other part. If you don't create new friction, i.e., if you're not doing quote unquote KYC in the wrong way, you're non-custodial about that. Yeah, at that point in time, it's basically game over, right? You just did exactly where we came from, what we need. You created peer-to-peer money.
So ultimately, that's the goal here: peer-to-peer money that has these qualities.
Right. And so now you got the first thing that does this, that you also understand. That's the most important part. It's money as a language. It's money that you understand. It's one-to-one what you already thought in your head that is money. Then eventually you don't really need that symbol anymore, right? It will be just the one. Just like we don't have many voice over IP protocols. We have one voice over IP protocol. I speak into it.
Just disappears, right?
Voice comes out, and yeah, if someone on the other end wants to see a different symbol in front of that, and you alluded to this earlier, yeah, we have this Babelfish function, right? Hitchhiker's Guide Through the Galaxy Babelfish function.
Just happens on the way over.
That just shows it to you, and that happens already, by the way, right now, right? I mean, obviously, when you have a digital wallet, what do you see? You see the translation in the language of value that you understand next to your Bitcoin price, next to your Ether price.
And you could change that at any time. You could say, I want to look at what it's worth in euro today.
Well, yeah, and obviously if you're in euro, that's it shows it to you in euro. So
precisely.
What does it tell you? It doesn't matter. So in short, and I've been saying this sentence for I don't know how long now, the default medium of exchange has been bytes for decades. The unit of account doesn't really matter, right? It's just language. It's irrelevant to the bytes, and the bytes should move at lightning speed. Store of value function is whatever you decide that your particular basket is, and it could go into the lending market, or it could go towards whatever else. Most of the time it's going to be lending, I think. At least that's the indication that we see now in DeFi. But other than that, like whenever you conflate the functions, that is the problem. That's the legacy problem. And people keep doing this with concepts like stablecoins and so forth. That's like intellectual time travel, and that's why I'm so mad about academics still teaching the old definition of Jevons. It hasn't been right at the time, and it's definitely not right today, because those functions have been split a long time ago. If they were ever relevant in combination together, they were hardly ever relevant. There was like a tiny part of the population for who that definition made sense for the technology that was money at the time for a short period of time. Anyway, I think we're at the end of our time.
I look forward to us being able to talk about money again soon. I love the idea of money just losing its numerical, like just kind of falling into the background where we're not even paying attention. Just resource allocation happening organically because we built the technology to manage it for us. Yeah. And I think that's the future. So I really look forward to building that future with you. I'm sure we're going to be working together on a lot of things in the coming months, but you got to come back. I always love seeing you. I always love a ton of stuff from you. So, we're probably going to be talking about personhood until we're old men, and until someone has figured it out. Right? So,
yeah. Call to action if this goes out early before I organize this conference. So I've been tasked to curate this event to work on identity related things.
Okay, so be sure to provide us with the information. We'll blast it out for you. Obviously, I'll want to be there. I want to hear you talk about this issue, this personhood, which is near and dear to my heart, and I think you understand it better than anyone I've ever met. I think we come at it from different perspectives, but literally every time we talk about it, I learn something new. I get a little new nugget of information. So thank you for sharing that with me. Hopefully whoever's watching this learns something about it too. Let's do this again soon.
Anytime.
Aloha, brother. Good to see you.